On InvestTalk today, we look at how you should prepare for the impending Fed rate cuts. Then we cover the sell-off in tech stocks today. We answer questions about Iron Mountain, Starbucks, Pulte Homes, and more. And then at the end, I cover how investors have reacted to the latest market sell-off.
This is InvestTalk, independent thinking, shared success.
Now, my focus point concerns this headline: 3 essential mortgage moves before the Fed cuts rates. And this is a time that a lot of people have been waiting for. Right? Rates have shot up. Everyone got used to 3% mortgage rates, and then inflation hit. And the Fed went into the steepest hiking cycle in decades. And, mortgages hit over 7%. Now they've kind of calmed down to closer to 6%. But even then, that's still higher than most people are happy with. They want lower. Okay. And we know that the Fed is set to cut rates multiple times between now and end of the year, most likely, and into next year. So how can you prepare? How do you know what you should look for to signal, okay, maybe it's time to refinance? Well, the first is know what your current rate is. Is it 30-year fixed? Is it variable? When does it adjust? Maybe coming up, maybe you did a 5-year ARM 3.5 years ago, and within 18 months, that could adjust a lot higher, right? So being very cognizant of what you're currently in and the structure of that mortgage, whether it's simple or more complex. And then know what to look for a potential refinancing opportunity. Now, rates are down, but it's still not low enough for the vast majority of people to refinance. Okay. Now, what I will say is, if you have roughly a 3% mortgage, give or take a 0.5%, either way, it's pretty unlikely you'll get a refinancing opportunity. I do not think that this is a cycle where we're going back to, next to 0% interest rates. And a lot of the recent move in rates is pricing in, right? Pricing in these rate cuts. Okay. So don't think that, the Fed's going to cut rates, maybe 100 basis points between now and year end, and that the mortgage rate's going to drop 100 basis points. Because remember, the market prices these things in. So the vast majority of that move is already in place. Okay. Now, could rates go lower? Remember, it's usually the 10-year is the best proxy for mortgage rates. And we've already had a pretty big move. Peaked out around 4.7% earlier in the year. And now we're at 3.8%. So you've already seen that roughly 100 basis point drop in the 10-year. Okay. So the next question will be is, what is that number based on your current rate, your current structure, that makes it worthwhile for you to refinance? So have a target, and then you can start monitoring it or do the work ahead of time. So okay, if it gets to here, then I should call around and I should try to find the best deal to potentially refinance. If you don't know that number, you don't know what you're looking for. Okay. Now, most people use the 1% rule. Hey, if it's 1% lower than my current rate, it's worthwhile to refinance. Well, that depends. On a small loan, $200,000-$300,000, yeah, probably. On a large loan, it could be only a 0.25 point difference. Could mean thousands and thousands of dollars of savings in just a year, right? Because the typical refinancing cost, Freddie Mac estimates to be around $5,000. So you have to divide those closing costs by your monthly savings. And that will tell you how many months it takes for you to recoup those costs. Typically, you want that to be a year or less. Okay. But it's different for everybody. Then you want to, once you know that number, then you want to be prepared, right? Lenders, every lender has its own criteria for a refinance. So, look at your numbers and, maybe hold off on huge expenses so that you have a larger cash reserve, because you always have to have some level of cash reserve typically to get these mortgages. And so obviously getting your financial house in order is always going to help to make sure that, hey, once you do hit that level where it does make financial sense, now it's can I actually get the loan based on credit score, based on assets, based on equity, et cetera. Okay, so be very aware of all of those things and then shop around. Once you get to that point, shop around. Freddie Mac estimates that you can save about $1,200 per year just by getting 4 different quotes. And that's usually ideal. About 3 to 4 different quotes from different lenders, different brokers is very important. Understand that these mortgage brokers know you're going to shop around, and you should. If you're not, you're doing yourself a disservice. So that's how you prepare going forward for this Fed rate cutting cycle. A lot of this is priced in, though. So don't think that, hey, we get 150 basis points of cuts in the next year, that we're going to go from mortgages at 6% all the way down to 4.5%. I don't think that's the case. 5 is probably, at least in the near term, the best you could ask for. And guess what? I could easily see Fed doing 100 basis points of cuts now, getting the Fed funds to the low 4s, for example. Maybe you get mortgage rates down into the mid 5s, and inflation starts to go back up next year because the dollar is weakening, and that puts a rally in commodity prices, for example. You're seeing that in gold. So understand that we're in a new regime, higher interest rates, higher inflation, even if right now we're getting a bit of the opposite in the short term. Let's take a look at the market today. It was a very interesting day. We had the big rally from the lows just a couple of weeks ago. And, you move pretty far, pretty fast, and that becomes an overbought situation. And you're bound to have a potential pullback, a potential rollover. And that's what you kind of got today. You had NVIDIA down nearly 4% and Tesla down over 5.5%. Those are really the big movers of the big names. Amazon down 2.2%, Apple down a little less than 1%, Microsoft down 2%, Google down 1.25%. And it was a market where certainly the growth side was the underperformer. And we hadn't seen that for the past couple of weeks. Large cap growth was down over 2%. Mid cap value was actually slightly higher on the day. I'm just looking at the Morningstar style box here. And so the growth side certainly had a sell-off, and very interesting to see this after that bounce back. And are we going to get a redux of that sell-off? Well, this is the first sign that may be ahead. We do have Jackson Hole tomorrow from Jerome Powell, what he's going to say that will move markets. What is he saying about the future path of policy? Are we getting 1 or 2 rate cuts in the month of September? And what does he see for maybe now, between now and year end? I think is a big question. So that will be certainly a market mover. And maybe today was front running that potential speech. And so we'll look at, so that was the market today. What were the other big movers? You had the dollar was up a little bit. And let's see what the yen was down. That was interesting, is that the yen wasn't a cause of this. The yen was actually down on the day. It wasn't an unwind of the yen carry trade like we saw a couple weeks ago. And gold did pull back a little bit as well on that stronger dollar, but still remains in a very, very strong uptrend. So that's the markets. So that was the market today. And once again, we will get much more market moving headlines, at least tomorrow. Even though there won't be a Fed change, it's all about signaling. Remember, the market always prices in the expected, rate policy, and that's what the market is attempting to do, and will attempt to do after tomorrow's speech.
Hi, this is Pam from Philadelphia. Thank you for your podcast. I really enjoy it. I'm wondering about international paper. I own international paper. I've owned it for about a year, and it's up like 35%. I'm wondering if you think it's a good time to sell or if I should continue to hold on to it. Thank you. Goodbye.
All right. Pretty good move in international paper. Thanks for the call, Pam. Now, this is one of the largest producers of packaging products in the United States. Accounts for roughly 1/3 of the North American corrugated packaging market. It also has operations in Brazil, India, and China. But 3/4 of its sales are in North America. So, yes, it has some international footprint, but it's mainly domestic, even though it's called International Paper, right? $17 billion market cap, roughly. About $5 billion-ish in net debt. That's fine. Free cash flow, about $700 million. That's gives it a free cash flow yield somewhere around 4.5%. Not amazing, but decent. Profitability, return equity is only 5%. That's pretty low. Historically, it's been much higher, and profitability has struggled lately. About a 4% dividend, a little less there, but that's fine. Certainly can afford to pay that dividend based on its cash flow and based on its balance sheet, which is solid. So I don't think the dividend is at risk. I just don't love the profitability metrics. And then if you look at the multiples it's trading at, enterprise valued EBIT is around 10, which is around the long-term average. Okay. So it's probably about fairly valued right now, honestly, in the high 40s. So I wouldn't be quick to sell it, but you're up good. I would probably relook at this and say, what is the percentage of my portfolio? Do I need to rebalance it a bit lower? Now, I will say technically you're getting some MACD divergences and you're getting some signs that maybe this rally from the April lows when it was around 34 is a little, it's losing a bit of momentum. So this is a good time to trim it, but I don't see anything majorly wrong with it that I would sell the whole position because the technicals are good. Once again, solid business, good cash flow, and nice dividend. So I would say trim it, but don't sell it. Thanks for the call. Now let's go talk to James in New York looking at CF Industries.
Yeah, I hold CF Industries, and I'm thinking of maybe selling it, or I'm not so sure. I'm not really seeing much price appreciation in it. I've had it for a year and a half, maybe 2 years, but not a lot of movement. I don't mind the dividend, but I don't know. Should I hold on to it?
Well, we actually own this for clients, so we like it. It's probably our favorite ag play, even though ag hasn't been the best place to be as of late. Let me take a look here. Yeah, hasn't been the best place to be, but we do like the CF Industries mainly because of the arbitrage between the cost of natural gas here as a feedstock into fertilizers and the difference between that and the cost of natural gas overseas. And so they make they have a steady business exporting overseas. Obviously, the domestic one becomes a bit more competitive, but they operate in Florida mainly. They have factories out there, and so that's easy export to especially places like Europe. So they have good cash flow, about $1.5 billion in free cash flow, trailing 12 months on a $15 billion market cap. That is $14 billion market cap, over a 10% free cash flow yield. That is very, very healthy. Return on equity is about 13%, which has come down, but longer term, it does average a bit higher. And then what are they doing with all of that cash? Well, they continue to buy back shares. 2018, they had 233 million shares outstanding. Now they have 180 million. And so we like what they're doing with their cash flow. They're buying back shares. And so I would not be quick to sell it. I would continue to hold. We hold it, like I said, for clients.
Okay, thank you.
Yeah, thanks for the call. Now, I hope you're telling your friends about the InvestTalk YouTube channel, where we share charts. You can see my face, and you can glean a little bit more than just listening to the podcast. So I encourage you to head over there. You can also comment and ask your questions, and we will answer one of those questions now. Audio Obsession 8845 says, when referencing short interest, does that take into account put options for the underlying stock as well? The answer is no. The answer is no. That is, it's important, but it's not that important, okay? Because short interest is the reason short interest is important is because if the stock goes up, there are potentially unlimited losses if you're short. And so oftentimes that can create a short squeeze. That's what, Roaring Kitty and Wall Street Bets were trying to do. Create gamma squeezes on companies that had high short interest to force people to go and buy it. Okay, which would force it up and create this market structure that would, double, triple, quadruple the stock in short periods of time. And so that's why short interest is important to see where's that dry tinder out there of those people that are short that are forced to buy. Okay. On a put option, you're not, right? The most you could lose is just the value of that put option. So that's why it really doesn't play into the importance of short interest. Thanks for the question.
Hello, this is Brett from Long Beach, California. Just wanted to get your analysis on StarBucks and Chevron. I am a big buyer of StarBucks and Chevron for long term. Just wanted to see if those are good holds or I should keep dollar cost averaging those, or what's your insight? Love your show. I'm listening every night. Thank you.
All right, looking at StarBucks and Chevron. We recently picked up StarBucks from the lows in the low 70s. After that sell-off in May, we've been buying it around the $75 mark. And then the new CEO came from Chipotle, and the stock is now up to 92, above all the major moving averages. That's a positive. Consolidating here in the low 90s, which is good. All bullish indications there. So we continue to hold it. I would continue to buy it. I do think they're a great brand. And the valuation, although not as nice in the low 90s as it was in the mid 70s, I still think it's fairly attractive. But there's still some work to do for the new incoming CEO to really turn things in the right direction. But he has a good track record with Chipotle. So we're still fans of Starbucks, and we continue to buy it on dips, especially if it gets back into the low 80s. What else? Oh, Chevron. Yeah, Chevron, obviously very well diversified. Them and Exxon are the two behemoths. And, we like Exxon a bit more, shall we say, than Chevron. So I would rather go with Exxon, but Chevron's just fine as well. Great company, good profitability. And I would be okay with buying Chevron or Exxon as well. All right, let's talk a little bit about your cognitive biases. Okay, and this is very evident in the crypto world, as well as think of tickets. And a good example is the recent Taylor Swift World Tour, where ticket prices were trading for, on average, 8 times their face value. Many of them hitting well over $1,000 per ticket. But if you're a Swiftie, you did not sell. Even though these prices, in many cases, would maybe change their life a little bit. But most importantly for them, it was seeing their favorite star in person. And so this does highlight, however, what psychologists and behavioral finance academics call the endowment effect. It's where you have a bias in favor of what you already own. These ticket holders or crypto investors might be up a giant amount, but they were valuing it much higher than they would otherwise because they actually own it, right? If they didn't own it, they wouldn't buy it, right? So that doesn't make sense, right? You missed out. You didn't get those tickets. Now they're over $1,000. I'm not going to buy it. So if you owned it, if you're on the flip side, you actually had owned it, you actually got those tickets, then by theory, you should sell because you wouldn't buy at these prices. And so it's very common for this to apply to equity investing as well, where because you made the decision you're the one that holds the particular stock. You want to be right. You think that company is better than you would if you had not bought it. Okay, and then you combine that bias with what is called the status quo bias, which is inertia, right? I'm fine, I'm doing well, I hold this position. It could be doing okay, it could be doing great, but you have to go in there and sell it. And now you have to think about where else you put that money. So it's easier not to do anything. Okay. And then there's the loss aversion part, which is, hey, I'm down. I don't want to crystallize my loss. I'm going to wait to get even. This is why charting works, because there's a bunch of people that bought at a previous high and then it rolled over and now it's back to that level. And what are those people doing? They're getting even. They're getting out. They're getting even, right? Oh, I'm no longer down. I'm even. I'm selling. So what does that tell you? Does that have anything to do with the value or quality of the business? No. It's just a psychological marker. And what this tends to do is it actually gets people to sell winners because they say, "Oh, I'm up. I'm winning. I'm making money. I'm going to lock some of that in." But those that are down, no, I don't want to sell that. Then I'll be locked into a loss. But the reality is the exact opposite. Why? Because momentum matters. Every statistical analysis shows momentum is important. Not the only factor, but it's important to the attribution of returns. Meaning if a stock is having positive price momentum, it tends to stay in momentum. The trend is your friend, and vice versa. So it's usually actually better to run with your winners, let them go within reason. Rebalancing is fine. But that's why, you hear on the show, should I sell it or should I buy it? Well, sometimes and most of the time, it's somewhere in the middle. But once again, the reality is you should let your winners run and ditch your losers due to that momentum factor. So I wanted to highlight that because this is a common mistake the average investor makes due to emotions. Simple as that. And as I said at the top of the show, emotions are your enemy. Now let's grab another caller question. You know the number. It's 888-99-CHART.
Hello, InvestTalk. Hoping you guys could do an analysis of Pulte Homes, where the ticker is PHM, where you guys see this company in the next year or two, given the fact that you guys talk a lot about how there's still a supply issue with homes. Seems like they continue to crush it, and each myself why I didn't buy this company. How you feel like home builders will do given the new, legislation that's passed on the Realtors Association and on Justin's focus point from the yesterday podcast. To me, it seems like it'd be more confusing for buyers, maybe even make it harder to buy homes and contribute to the supply issue. I just want to know what you guys think, and if it's a good buy, if it's too expensive. Thanks.
Well, I actually think it's the opposite when it comes to these new rules. It's cheaper now to sell, right? You don't have to pay 5%. You only have to pay maybe 2.5%, 3% to your listing agent. And therefore, that transaction cost is likely to shrink. Now, how much, kind of depends on each market and how things are evolve. But I think on the margins, it will probably help supply a little bit. But Pulte, we actually had owned this for a while. And this is another good example. We had, those issues with trimming those gains, we have those as well. We bought this in the, I think, 30s or 40s, and it ran to mid 80s. I think that's when we kind of cut it. Now it did pull back a little bit. And then we thought, okay, we were smart. And then it ran back up. Now it's at 129. And so, Pulte is one of our favorite home builders out there due to its diversity of the markets that it operates in. 46 different markets in 26 different states. And I do agree that home builders in general are going to continue to do fairly well because of that limited supply. Now, supply is starting to rise. You're going to see these big doom and gloomers on YouTube and social media. Oh my God, inventory's up 82%. Everything's going to crash. No, not the case. Why? Because you're coming from a very low base and things are just kind of getting back to normal. So I like your thought process here. I like Pulte Homes. The momentum is solid. So yeah, I do think it's a bit overvalued, but the trends are good. And so I'm not against buying Pulte. It's definitely near the top of our list as of the home builders that are out there. So if you're looking for exposure, you are barking up the right tree.
Hey, Justin and Luke, this is Frank from LA, long-time listener of the show. Thanks for all you guys do. Last week, you guys mentioned senior housing REITs as a potential investment to look into, given the gap between supply and demand in the future. I've always been interested in the field, but I found it hard to find suitable companies. I looked at several senior housing REITs, and they all seem to be fairly priced at the moment, if not overpriced at this point, I guess. I was looking at a couple that I think might still have some potential upside, and one of them is LTC Properties, ticker symbol LTC. It has a pretty nice dividend, but I don't know how sustainable that is based on their adjusted funds from operation. Another question that I had is, would you wait for some of the main names to retrace a bit and pick a few good ones? Or would you invest in an ETF? I'm having a hard time finding an ETF that bundles different senior housing REITs. The closest I found is AGNC, which is overly indexed towards healthcare and pharma rather than REITs. So that doesn't really cover this strategy. We'd love to hear your opinion, and thanks for all you guys do.
All right, looking at LTC and LTC Properties. And this is a healthcare facilities REIT. It does have senior housing and healthcare facilities in its portfolio. And so it has independent living communities, assisted living communities, memory care communities, skilled nursing centers, as well as other types of properties. It's okay. Return equity is around 10%, but it's a small name, about $1.5 billion market cap. Its free cash flow is solid, about a little over $100 million. The trends, and that's headed higher, which I like. I don't hate it. It did have a recent sell-off. I would see what the reason is for that back on July 30th. I need to dig into that story. It was that earnings and were things, what were the trends there? The technicals since then have been bearish. They've just been kind of consolidating here in the mid 30s, and today it had a rough day, down over 1%. So I would be patient on this particular one. It looks okay on the surface level, but I would continue to dig. AGNC, that's an interesting play. It has a 50 basis point expense ratio. That's a little high, but I wouldn't mind something like that. It's mainly healthcare, right? 92% healthcare. So I think that's probably more of a healthcare replacement as opposed to a REIT replacement. An LTC, it's fine. But I think you can find better out there within the space. Thanks for the call.
Hello, this is James from Georgia. I was trying to contact Justin or Luke regarding Iron Mountain Incorporated. Ticker symbol is IRM. I've been holding the stock for a while. I was trying to see if you could look into it to see how it's performing currently and what the outlook is for this particular holding. We greatly appreciate all you do, and we'll listen to the show for your answer. Have a good day. Thank you.
Well, Iron Mountain is performing fantastic as of late. And for everyone else out there, this is a REIT that basically provides record management as well as storage services. And so it's kind of a weirdly structured REIT. Surprised that they get away with it. But, it's a name that's on its hair. It was at $57 last October. And today it's at $112. So it's nearly doubled since then, and pays a 2.5% dividend. So it's been a fantastic performer. But to me, it's gotten way, 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 way ahead of itself. It's extremely overbought on a weekly chart. And interesting enough, some insider selling is going on here in a big, big way. So I would not be buying it now. I think it's gotten ahead of itself. and definitely needs to cool off and is definitely overvalued. So I would pass on Iron Mountain for now. Although near term, the momentum is strong, so it could continue for a little bit longer, but not a good entry point at the current time. Now let's talk a little bit about this rebound in equities. And we had that dramatic sell-off just a couple of weeks ago. Okay, but a recent report from, I believe it was Bank of America, B of A, showed that positioning is nearly back to where it was pre-sell-off. Investors poured money back into index options, mega cap tech stocks, cyclicals, and defensives. What's interesting, though, is that if you look at kind of the growth to value trade, is that growth sold off in a big way, basically starting in, let me go to a daily chart here. What was that? Top. It was July 9th, actually. So it's been a while. Then you got to bounce back the last couple weeks. But today, that big sell-off in growth. And so, but it didn't get near where it was in July. And so I think you've had that rollover here in the mega cap tech names, even though people continue to kind of buy in on any dip. But I think it's a fool's errand at this point because of kind of the macro trends behind it. Now, money's also flowing back into volatility controlled funds. And so that's why you saw the VIX come down a lot. So that also helps equity markets. And so what happened a few weeks ago was just a very crowded trade started to get unwound. And the money is pouring back into those trades. And so it gives even more tinder for another continued sell-off. Now, global equity markets last week notched their best weekly run since November. Okay, mainly because the economic data, I know the jobs number wasn't great at the beginning of the month, but since then, the economic data seems okay. Now, the Fed funds futures market is showing 4 rate cuts by the end of the year. And credit investors, they don't see any problem. They see a soft landing in the U.S. economy. And 3 in 4 respondents now expect U.S. inflation to slow without triggering a recession, which is basically Goldilocks. That is a good scenario for equities. Continued economic growth, not amazing economic growth, but economic growth nonetheless, and inflation continuing to ebb, which gives room for the Fed to cut. Now, the number one concern in markets, well, it's geopolitics. We know that. The election, what's going on in Russia and Ukraine, as well as the Middle East, and then obviously China. And then central bank policy is the next on the list. But clearly, the Fed is trying to get ahead of this a little bit. Okay, and so very interesting set of reports here that show how investors have reacted. But if you look at the actual trends, this was just a counter trend bounce in many ways. And that's why I think you will continue to see a choppy market between now and the election. The election's still a bit ways away, right? Over 2 months. So I wanted to highlight that because it's important to get some context to this bounce and what it really means for markets as we close out the quarter. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.